Everyone, this is Dr. Duru from Ahan Analytics with the market breadth. Today was another big trading day. The headlines are should be screaming out to you on this timestamp, May 12th after market. The big news is here. Stocks soar as US-China trade pact triggers buying spree. I was not expecting such a major concession that from the U.S. side. Here's a headline that just tells you all you need to know. Xi's defiance pays off as Trump meets most China trade demands. Just think about it this way. Think about all the rhetoric that went into jacking up tariffs against China all the way to 145%. Now the US has rolled it back all the way to 30% just for the privilege of talking for another 90 days about trade tensions. And my prediction, and I hate to make predictions, but I have to make one in this case, is that in 90 days, they may be a little closer, but not enough is going to get resolved. So it's going to be a rolling set of tariff pauses and back and forth. So just brace yourself. Now, the good news is that given what we saw in the tariff trauma in March and April, we now see policymakers who are ready and willing to respond to the market. So remember what I've been talking about in the past is the way that this is supposed to work is that the markets panic, policymakers panic, policymakers act, and then the market gets its due, or in other words, it gets the goodies that it wants. And in this case, the goodies have just been pauses on tariffs. So the ultimate goodies are still somewhere out there in the future, but this is enough to get the market very, very, very excited. And talking about the future, you can see here that the GOP tax bill is moving forward. And that means a lot of fiscal stimulus is going to come into the economy starting, I guess, next year, meaning that a lot more money is going to go into the pockets of people. And that means stimulus because about two-thirds of the economy is consumer spending. So, to the extent that the tax bill is going to make people feel richer right away, you can bet that next year is going to be gangbusters. So, we've got a lot of buffers now to future market pullbacks. We'll see how deep the next pullbacks go, but my current operational mode is to buy any and all pullbacks until or unless some major supports get violated. Let's see where we are on market breadth. So, my favorite technical indicator, the percentage of stocks trading above their 50-day moving averages, what I like to call AT50. Just as I was writing about and just as I talked about last week, I suspected that we would get to this sort of convergence or synchronization of testing the overbought threshold as well as testing the 200-day moving averages on the major indices. We got a little bit more than that. You'll see that in a second. So I just love the magic of this technical, sorry, of this market breadth indicator. Look at this. So I mark 70% as the threshold for overbought. What does overbought mean? Means that the buyers have gotten so excited that they have pushed a large percentage of stocks above a key moving average. In this case, it's the 50-day moving average. So that's a shorter term moving average. But when so many stocks are above that, well, the buying power is starting to get concentrated, right? Now, in this case, what we have is a very damaged 50-day moving average. So a lot of stocks that have jumped over that hurdle have jumped over a downtrending hurdle. So that means that there could be a lot of room to go to the upside, particularly if there's 200-day moving average resistance in weight. So anyway, like I said, I love what happened today. My favorite technical indicator, AT50, rallied. Oh, in fact, it opened right below 70%, which is the overbought threshold. In fact, it got, I think, to 69.7%. You can't get any closer to that, and it fell back. Now, per the AT50 trading rules, this is the beginning of a bearish move. But, and I'll show you again why soon, I am not flipping bearish from my current short-term bullish trading stance. Because even though this has been a very sharp ascent, I think that a pullback has to be bought because a pullback would just be a natural cooling of this overheated move to the upside. So let's see what we can expect on a pullback. So first of all, here's the percentage of stocks trading above their 200-day moving averages. It finally got over the last high, but it closed below. So this downtrend of lower lows and lower highs is still intact, unfortunately. So this is one thing tempering the bullish outlook. But it's still promising, even though again, look how extended it is. It's above its own Bollinger Band. The Bollinger Band, remember, defines the majority of the price action. In statistics, it's two standard deviations from the 20-day moving average. So you expect most of the pricing action to happen within the band. To the extent it goes above or below, price action is overextended. Let's take a look at the VIX. I'm going to shift over to the logarithmic view now. The VIX, of course, completely plunged today, and now it is below the level um, that's considered elevated. 20% on the VIX, sorry, not 20%, 20 on the VIX is considered elevated. Now we're getting back to the levels of complacency that dominated before we ran up into this tariff trauma and drama. So that's something to keep in mind. This is actually supporting the bullish mood, but it also means that now put options should be cheap enough for you to want to buy for protection. Okay, now the S&P 500, this is what I mean by I am not ready to go flip bearish as the AT50 trading rules might suggest I should get ready to do. The S&P 500 cleared two important hurdles. It cleared the 200-day moving average, and it cleared this resistance level that's formed by the close on election day last November. So, remember what I've said before is that everyone who bought all excitedly post-election was going to be relieved to get their money back. And you see, that's what happened here in March, is that when we hit that level, the sellers took over again. They said, "Oh, thank goodness, we're back there. I'm back to even, or I've limited my losses," and then that just set us downhill. Now that we've cleared that, that means we've cleared a major bearish uh, point of resistance and a bearish hurdle. So the S&P 500 is in the clear. Pullbacks back to the 200-day moving average would be very natural, nothing to be alarmed about. If it pulls back below that 200-day moving average, that would be something to worry about. And of course, worry even more if it goes below the 50-day moving average. So those are the key levels that I'm looking at. But again, any pullback should be well supported. Particularly here, look, the 20-day moving average and the 50-day moving average are even converging, and a pullback to that level should be well supported as well. So, if you have any questions about this or if there's any technical jargon that I've laid out there, just put the questions down below. And don't forget to share and like this content so that the algorithms know what's up. And of course, you can always subscribe and click on that bell icon so you can get notified for new content. And also note that this is for educational purposes. Please trade and invest according to your own risk tolerances and time horizons. Okay, let's quickly move to the NASDAQ. The NASDAQ similarly cleared a major hurdle. I didn't draw the line back to the election close, but let me just do it virtually here. You can see the dotted line here defines the election close, and the NASDAQ too has done what the S&P 500 did, which is clear the hurdle of the 200-day moving average resistance and the resistance, implied resistance from the close on election day. So it too has an all clear signal to get to re-challenge its all-time high. In fact, when I look at where it is now, I think the only remaining stiff resistance could be from the lows from January. So that's something to watch. Given the excitement, I don't expect that resistance to hold much. So let's take a look at how long it takes to get back to all-time highs if that's indeed where we're going. Now, my big miss, and I talked about this before, how bullish I've gotten now on the small caps. This is IWM, the iShares Russell 2000 ETF. It gapped up 3.5% today. It was the biggest mover of the day. Sorry, actually, let me just quickly confirm that 3.3% on the S&P 500 and the NASDAQ, no, 4.4%. Okay, so small caps was right in the middle there, so it wasn't the biggest performer, but still, given how bullish I was on this uptrend line, I really should have had a position, but I was getting a little too cute. I wanted to wait to see if it could pull back into this line. So, oh well. You win some, you lose some. I do expect now, more so than the other indices, IWM is overextended. It's above its Bollinger Band. So some cooling off will not be a surprise. I want to be a buyer anytime it comes back to this uptrend line. I think it's, my expectation, this is not a prediction, but my expectation is that it will come back to this uptrend line before it tests this important 200-day moving average resistance. Okay, so those are the major averages. Here are a few stock charts that caught my attention. I'm just going to fly through them really quickly. Spotify actually gapped down and sold off for 4.2% loss. Unfortunately, I did not have enough time to see what the news headlines were about here. I didn't see anything down here on TradingView either. In fact, there was a analyst that raised its price target. So this could be a buying opportunity for those of you who are bullish on Spotify. Just note that this underperformance is kind of a yellow flag, if not an all-out red flag, given that Spotify fell back below the former all-time high. Okay, let's take a look at the euro because, as you know, the dollar really suffered a lot during the tariff trauma and drama. Now, with the trauma and drama behind us, and now euphoria has taken hold, you can see the euro has lost a lot of steam. FXE, which is the Invesco Currency Shares Euro Currency Trust, which represents the euro trading against the dollar, is testing 50-day moving average support. So that's something to watch very closely. Okay, Robinhood. This is one of many stocks I did sell and take profits today. And just as a part of my strategy, particularly for stocks that I bought during the sell-off, I want to lock in profits because I want that cash cushion available to me when, sorry, I should say if and when the market pulls back, because again, I'm bullish enough that I want to be buying all of the pullbacks up to, of course, the resistance levels that I discussed before. So Robinhood was one of those. I'm still a big fan of Robinhood. I'm not bearish on the stock at all, but it's just prudent risk management for me to take some profits here, and I will deploy them as opportunity sees fit. I almost took profits here on Dollar Tree. This is one I've been talking about. It surprised me how strong it was, even while the tariff drama and trauma was still going on. It gapped up 4.1% today. It is now it's now pushing into another gap that came from last summer. So I almost pulled the trigger on the profits here, but I decided, the tailwinds are all behind Dollar Tree. Let me just see if it can keep going. I will close it out if this gap closes. And the other reason why I was wary is that competitor Dollar General did not benefit from today's news. That really surprised me. I know they have different supplier models. I'm not sophisticated enough to um, be able to describe what those are, but it is curious that Dollar General fell back 2.4%, while Dollar Tree gapped up and soared as I would have expected. So I should just be thankful that I was actually in Dollar Tree and not in Dollar General. That's just plain luck. Micron, this is another good one. Now this is a kind of stock that I need to point out. I was taking profits all along the way. Once Micron, ticker symbol MU, tested 50-day moving average, and now that it gapped way up 7.5% and stopped just short of 200-day moving average resistance, I definitely needed to take profits there. This is a hedge position, so if it pulls back enough, I will close the short part of the hedge, and I will just call it a day. But right now, the trade has been working. This hedge trade has been working all the way up. This is how important the 200-day moving average resistance has been to Micron. You could see here all the way since it first broke down below it last summer. It's not been perfect resistance, but Micron in particular this year has had a lot of trouble banging against this line and falling back. So, until proven otherwise, I expect the same thing to happen here for Micron. Now I'm going to show a stock before it reports earnings. Oh, I guess it's reporting earnings right now, down 5.3%. This is Hertz Global Holdings, HTZ. You could see back in April, it really soared like crazy. I was a skeptic of this run up. So I'm very curious to see what real news Hertz reports. And this is actually a bullish setup. If it weren't for earnings, I would never buy something like that's soared like this ahead of earnings. So this is on my list to just take a look at tomorrow. Definitely would never short this stock, but I want to see whether the earnings news will can motivate me to go ahead and take a chance and buy it. And Hertz, of course, is a rental car company. Shopify was another chart of many charts that caught my interest. Um, this was on my buy list, but I couldn't quite buy it because on Friday it pulled back from the 50-day moving average resistance and actually closed below this converged line. So that was really important to keep an eye on. And, unfortunately, again, like I say, you win some, you lose some. It surged 13.7% today. And what I also missed, and one of the things I've talked about before is that if I miss a move like this, I try to buy somewhere on a 50% retracement of the gap up on that day. And Shopify got pretty close, but by the time it got down to here, I wasn't paying close enough attention, and I hadn't put in my limit orders yet. So I just completely missed that one. So anyway, that's it for today. Tomorrow morning, Tuesday, May 13th, CPI is coming out. It's people, economists, pundits, whatever, expect some of the tariff inflation to start showing up in the CPI number. To the extent that happens, I expect the market to freak out a bit. It probably won't reverse all of today's great gains, but on a CPI freakout, I want to, again, to be a buyer because that would be what we call a trigger reaction. That's, sell first, think later. And the reason why I want to buy a CPI freak out, even though I'm very wary about inflation picking up later on, is that again, if I think about this model of the market panicking, policymakers acting, and then the market responding favorably, is that going forward, any bad inflation prints are going to further cool the heels of our policymakers and make them start to tweak and adjust things to get the inflation pressure off. Even if it doesn't work, even if it fails over the longer haul for the short term, that's the dynamic I want to be playing bullishly for now. Again, until something else comes up that erases that strategy. Okay, thanks for checking this out. Again, as a reminder, like and share this content so the algorithm knows what's up. If you have any comments or feedback, you can always put them down below. Subscribe to this channel. I'd really appreciate getting more subscribers. I got over the 300 mark, woohoo, recently. As you can imagine, all this market turmoil has brought people looking for more information. I'm happy to be that provider for some of you, for those of you who are sticking around. And of course, you can hit that bell if you want to get notified when I publish the next content. Take care, be careful out there. And please also, if again you're interested in this content, keep an eye out because we are at, I'm calling this the one from one cliffhanger to the next, a breakout to oversold, oh, sorry, yeah, overbought resistance. So that means we're still at another cliffhanger moment. And that means that somewhere down the line, I may be forced to get bearish. But hopefully I described the conditions under which I would get bearish, but I am not bearish at this point, and I haven't been bearish in quite some time. All right, take it easy, and I'll check you out the next time.